Welcome back to Iron Financial. We are here to help you forge a stronger portfolio, cut through all this market weakness we're seeing, and really analyze the structural integrity of the biggest players in the market today. I'm your lead analyst, and look, today we have an absolute monster of an earnings report to dissect.
And I'm the market skeptic. Today we're digging into a core mystery that's honestly been baffling casual retail traders across the board. You know the story. Amazon just reported their Q1 2026 earnings. And on paper, they completely crushed expectations. I mean, the revenue was massive, the growth was accelerating. So casual retail traders saw that headline beat, probably bought call options blindly, and absolutely expected a massive rally. And yet, the moment those numbers hit the wire, what happened? The smart money started selling immediately, and the stock actually dropped 2% in after-hours trading.
Exactly. It's a classic setup. When a company does that much heavy lifting, posting incredible top-line numbers, and still sees its stock price sag right out of the gate, it means we need to look past the fresh coat of paint. We've got to get in there and inspect the structural steel underneath. Are we looking at an impenetrable financial fortress here? Or are there massive underlying liabilities weighing this whole stock down? We are going to find out right now. Let's dive in.
All right, here is the blueprint for today's explainer. First, we'll lay out the Q1 earnings triumphs. Second, we pivot right to AWS and the AI engine. Third, we are looking at the Anthropic asterisk. Fourth, we tackle the capital expenditure reality. And finally, we'll deliver the verdict on the market's reaction.
So, Section 1. Q1 earnings triumphs. A solid foundation?
Let's kick off this drill down. Here at Iron Financial, we always start by inspecting the foundation. And on the surface, Amazon's balance sheet looks like a reinforced concrete bunker. The top-line numbers are engineered for absolute dominance. Just think about the sheer tonnage of that Q1 revenue number. $181.5 billion generated in a single quarter.
It's just a staggering amount of money to move through a single enterprise in 3 months.
It really is. That's a 17% year-over-year growth rate from the $155.7 billion they posted this time last year. And even if you exclude a $2.9 billion favorable impact from foreign exchange rates, they still grew a massive 15% organically. Now remember the context here. We are in a macro environment where high interest rates are applying serious, sustained pressure to consumer wallets. Pushing out $181 billion under those conditions, that is an absolute engineering marvel. Wall Street had essentially priced in an expectation of around $177 billion. Amazon didn't just beat that, they shattered it by billions of dollars.
Okay, it's an impressive top-line beat, no doubt about it. But look, revenue is just top-line vanity if you can't actually convert it to the bottom line. Pushing that much volume through your fulfillment centers doesn't mean a thing if your operating margins are crumbling under the weight of it all. So did they actually retain any of this strength, or did they have to completely sacrifice their profitability just to get those sales numbers up?
They absolutely retained it, and the comparison here is striking. Operating income surged from $18.4 billion in Q1 2025 straight up to $23.9 billion in Q1 2026. That is a 30% structural surge in operational profitability. And that operational leverage drove their consolidated operating margin up to 13.1% for the quarter.
Okay, a 30% jump in operating income is some serious heavy lifting. I'll give them that. But as the skeptic here, my job is to tap the load-bearing walls. I really need to know if this sustainable structural strength is broad-based across the whole company, or if they just quietly fired 10,000 workers to create a one-off efficiency gain to make the quarter look good. Is this entire $181 billion operation just being propped up by one lucky division? What does the segment breakdown actually tell us?
The strength is completely broad-based. This isn't a one-trick pony holding up the roof for the whole organization. Let's inspect these pillars one by one. First, advertising revenue. It grew 24% to $17.2 billion. And management actually confirms that advertising has now topped a staggering $70 billion run rate over the trailing 12 months.
That's massive.
It's massive. And remember why it matters. Advertising is practically pure margin. Unlike picking, packing, and shipping a physical cardboard box across the country, serving a digital ad on their platform costs them fractions of a penny. That $70 billion is high-margin rebar reinforcing their entire operation. Meanwhile, North America retail sales grew 12% to over $104 billion. International sales were up an impressive 19% to almost $40 billion.
Right, but what about the actual e-commerce volumes? Because we know that inflation and price hikes can easily mask stagnant physical growth. Are people actually buying more stuff, or just paying more for the same stuff?
No, people are buying more stuff. E-commerce unit sales grew 15%. In fact, CEO Andy Jassy specifically noted on the call that this is the strongest unit growth rate they have seen since the waning days of the COVID-19 lockdowns. They've already shipped over 1 billion items same day or overnight in the US so far this year. So to answer your question, the retail foundation is rock solid.
All right, Section 2. AWS and the AI engine. Heavy lifting.
Okay, so the retail and advertising pillars are holding up the roof, but let's be totally real for a second. The broader market doesn't value Amazon primarily as a traditional retailer anymore. The real heavy machinery driving this company's valuation is the cloud. We need to see what is actually powering this AI engine everyone keeps talking about.
And this is where the engine is just firing on all cylinders. AWS hit $37.6 billion in net sales for the quarter alone. But listen, the metric you really need to pay attention to here is the acceleration. The acceleration is just undeniable at this point. Look at the trend. In Q1 2025, AWS growth was sitting at 17%. Last quarter, it bumped up to 24%, and now it has climbed to 28%. That is the fastest pace of growth AWS has seen in 15 quarters, and it generated $14.2 billion in operating income all by itself.
Yeah, to push a massive $38 billion base up by an accelerating 28%, that practically defies the law of large numbers. A reacceleration of that magnitude is incredibly difficult to engineer for a company of this size. It proves that the AI narrative isn't just a fun story for earnings calls anymore. It's converting into real, hard cloud consumption. But what is physically being built to support all this? Are they just reselling compute they bought from someone else, or are they actually forging their own hardware?
Oh, they are forging an absolute empire of custom silicon right now. Amazon's internal chips business, which includes their Graviton, Trainium, and Nitro lines, has now exceeded a $20 billion annual revenue run rate. And that business is growing at triple digits year over year. Think about this. In just the last 12 months, they have landed more than 2.1 million AI chips directly into their data centers, and more than half of those were their own proprietary Trainium chips.
That's a ton of silicon. But who's actually buying all that custom compute power?
The absolute biggest players in the entire game. OpenAI just secured a commitment to consume 2 gigawatts of Trainium capacity starting in 2027. And Anthropic? They committed to up to 5 gigawatts of Trainium chips just to train their advanced models.
5 gigawatts?
Yeah, to put that scale in perspective for everyone, 5 gigawatts is enough power to run a major metropolitan city. We are talking about drawing the power equivalent of millions of homes just to train Anthropic's AI models. Plus, you have Meta deploying tens of millions of AWS Graviton cores for their agentic AI efforts. The structural demand here is locked in tight.
All right, Section 3, the Anthropic asterisk, cracks in the armor. All right, hold on. Let's halt the hype train for just a minute. We've established the foundation looks strong, the top-line revenue is huge, and the AWS engine is roaring. But in financial analysis, especially here at Iron Financial, you always have to inspect the foundation for cracks. You mentioned Anthropic's power commitment a second ago, but let's actually talk about Amazon's investment in Anthropic. Because I am looking closely at the net income figures for this quarter, and I see a massive structural illusion.
Walk us through it.
Well, the headlines reported a net income of $30.3 billion, which translates to a reported earnings per share of $2.78. Retail investors saw that massive EPS and thought Amazon completely blew the doors off the bottom line. But when you strip away the accounting mechanics and look at the adjusted operational EPS, it was actually only $1.61. And guess what? Wall Street analysts were expecting $1.62. Operationally, they actually missed the bottom line estimate by a penny.
See, that is a absolutely critical distinction to make. Institutional money managers aren't fooled by paper markups. The market prices companies based on sustained, repeatable operational cash flows, not one-time paper anomalies. When you strip out the accounting tricks, you see the actual structural integrity of their quarter. So what exactly created that massive gap between the reported 278 and the actual operational 161?
It all comes down to this number right here, $16.8 billion. That is the pre-tax gain Amazon recorded in non-operating income from their investment in Anthropic. Because Anthropic's private valuation skyrocketed recently, Amazon had to legally mark up the value of their investment on their own balance sheet.
Exactly. It is purely a paper gain. It artificially inflated the bottom line numbers. Now, don't get me wrong, it's a brilliant strategic investment that is paying off handsomely on the balance sheet, but it is not cash generated from selling physical goods or renting out cloud space this quarter. And this right here is the core mystery we open this whole explainer with. Casual traders saw a massive $2.78 EPS and couldn't figure out why the stock sagged 2% after hours. Well, the smart money saw that they actually missed the true operational estimate by a penny. If you miss this Anthropic asterisk, you are analyzing a completely distorted blueprint of Amazon's true profitability.
Which brings us to Section 4, Capital Expenditure Reality, the cost of forging the future. That Anthropic asterisk leads us directly to the absolute most critical part of our drill down today. Because if net income was artificially inflated by paper gains, we need to look at the hard, cold cash. We have to analyze the cash flows to see if Amazon is actually bleeding capital to build this AI fortress we've been talking about. And there is a staggering dichotomy in Amazon's structural financials right now. Over the trailing 12 months, their operating cash flow climbed 30% to a massive $148.5 billion. So they are generating an absolute mountain of cash from their core day-to-day operations. However, look at the free cash flow. It absolutely plummeted from $25.9 billion a year ago all the way down to a mere $1.2 billion today.
Wait, let me get this straight. They generated $148.5 billion in operational cash, but after all their capital investments, they only have $1.2 billion left over in free cash flow? Where on earth did over $140 billion in cash go? That is literally the GDP of a small country just vaporized from the balance sheet.
It didn't vaporize. It was poured directly into concrete, copper, and custom silicon. A massive chunk of that cash flow discrepancy is explained by a $59.3 billion year-over-year increase in property and equipment purchases. This figure represents the absolute raw cost of forging the future of artificial intelligence. Amazon is taking almost every single spare dollar of cash they generate and shoving it right back into the ground. And we aren't just talking about buying a few extra servers here. This is massive land acquisition for hyperscale data centers. This is miles and miles of industrial-grade copper wiring, entirely new power grid connections, and heavy-duty liquid cooling systems designed to keep those AI chips from melting straight through the floor. And the crazy part? They are not slowing down. To really hammer home the sheer scale of this build-out, Amazon is projected to spend approximately $200 billion in capital expenditures for the full year of 2026. In Q1 alone, they pushed $44 billion out the door in capital expenditures. Do the math on that. That is nearly $500 million being spent every single day just to build out capacity for Trainium chips, NVIDIA GPUs, and AI services like Amazon Bedrock.
$500 million a day? Every 24 hours? That is an awe-inspiring and, frankly, terrifying burn rate. You are essentially building a brand new, fully loaded skyscraper every 24 hours and just hoping the tenants actually show up to rent the office space.
And this is exactly where we have to ask the really hard questions. Amazon is executing one of the most aggressive investment programs in tech history. Are they overextending their structural limits? Think about it. They are pouring everything they have into global data center expansion and hoarding AI compute. The sheer weight of the $200 billion Capex program is a massive strain on free cash flow. And tech hardware ages incredibly fast. An AI chip that is state-of-the-art today is practically a paperweight in 3 years. If this broader AI demand materializes even slightly slower than expected, they aren't left with an appreciating asset like prime real estate. They're going to be left with billions of dollars in highly expensive, quickly obsolete data centers and absolutely crushed free cash flow margins.
And that brings us to Section 5, the market's reaction, the verdict.
That structural tension you just outlined brings us right to the verdict. We started this explainer with a mystery. Amazon posted $181 billion in revenue, 28% AWS growth, and expanding margins across the board. Yet the stock dropped 2% in initial after-hours trading. So is this stock a buying opportunity or is it a value trap for your portfolio? Let's consult the market analysis. Market skeptic. This quote from XTB Analysis nails the current sentiment perfectly. Quote, the market is shifting its focus away from current earnings performance and toward the question of how quickly these investments will translate into sustained acceleration in cloud growth and meaningful AI monetization. See, investors are not questioning Amazon's current operational quality. The e-commerce strength and the advertising run rates, those are undeniable. But the market is shifting its focus. Wall Street isn't satisfied with strong operational metrics today if it requires vaporizing your free cash flow to get them. Investors are demanding proof that this $200 billion structural overhaul will actually pay off, rather than just becoming a permanent, incredibly heavy capital burden. And I completely agree with the XTB analysis there. For the retail investor listening to this deep dive right now, meaningful AI monetization means Amazon actually has to prove they can charge end users enough for these AI services to cover that $500 million a day burn rate. It can't just be an impressive, incredibly expensive science project. It has to be a reliable cash machine. But to be fair, management remains incredibly confident in their blueprint. Just looking at their Q2 2026 guidance, Amazon expects net sales to hit between $194 and $199 billion, which represents another 16 to 19% year-over-year growth. And they are projecting operating income to stay really strong, somewhere between $20 and $24 billion. Now, this guidance does assume Prime Day happens in Q2, which will inherently boost the retail side, but it clearly shows they believe the foundation is strong enough to bear the weight of these massive investments.
Sure, but projecting top-line strength is the easy part. Management assuming they can just maintain those massive operating margins between 20 and 24 billion while actively spending 200 billion over the next few years, that is the real structural stress test. I mean, anyone can draw a sturdy-looking building on a blueprint. Actually pouring the concrete and keeping the budget intact is another story entirely.
So here is the final question you need to answer for your own portfolio. The structural integrity of Amazon's core business has honestly never looked better, but they are gambling their free cash flow on the most aggressive infrastructure build-out in tech history. Is this $200 billion AI bet a guaranteed future that will create an absolutely impenetrable moat around AWS? Or is it an incredibly expensive waiting game that will act as a financial sinkhole for the next 3 years?
That is the heavy lifting you have to do as an investor. The numbers on the page show a fortress, but the cash flow shows the massive, ongoing cost of keeping those walls up. Let us know in the comments if you think the walls will hold. Keep your portfolio strong, cut through the weakness. I am your lead analyst.
And I am the market skeptic.
And we will see you on the next deep dive, right here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.